I think that what we've seen with cryptocurrencies, I think they will prove to have done society, not investors, society, a massive, massive favor, because they have forced themselves onto the headlines, onto the agenda. And whether you invest them or not, many, many people are now familiar, certainly with Bitcoin. They don't know what it does. They don't know anything about mining, let alone halving or forking or hot and cold wallets. They don't need to worry about that. But what it's done is force people to think, what could you do? And therefore the ability to effectively digitize, take out the paperwork and create an electric version of different asset classes.
Everybody, Mr. Jonny Fry. Jonny, thank you so much for your time.
No, you're very welcome. But Marcus, before we get going, I'd just like to perhaps dispel sort of a couple of sort of comments there, because I feel quite strongly about the subject of people who profess to be experts and anyone that's evangelical when it comes to the technology and in particular digital assets. Yes, I've got over 30 years of experience in the asset management industry and managing people's money and compliance and regulation, which is really, really important and is vital in order for this new asset class to grow. But the market's evolving so quickly. And although I spend at least 20 hours a week actually writing analysis in the form of something called Digital Bytes, which looks at how, where and why the technology is being used, how, where and why these assets are being used, and what's the implications because people and organizations and governments and companies. I still don't profess myself after 4 years old of being an expert, because it's moving so quickly, and that's for me, that's part of the fascination, because we can learn from each other, and by trying to be grounded and perhaps a bit more humble, you don't become dogmatic in your views, and you say, wow, I hadn't realized that there was that limitation, or you really could do this. So, but yeah, I spend a lot of time, and I suppose I know, yes, I do know quite a lot about the subject, but I'm not an expert, because I've yet to meet an expert, because the subject matter is so huge and it comes to so many different things. But yeah, delighted, and thank you for asking me to be on the program.
Thank you for coming. Okay, I'm going to take you back. You started with, and this is something I read about you. You started your first asset management business from a shed and built that to a £1 billion or dollar organization. Can you tell me a little bit more about that?
Well, it wasn't quite a shed. It was a flat in Shepherd's Bush, which had a shed in the garden. But I basically thought I was at the cutting edge of technology, because I went out and bought a television with teletext on it. And with teletext, it meant that you could actually get the price of stocks and shares with a 15-minute time delay. So instead of looking at the Financial Times, which had a 24-hour time delay, I was getting information to my clients, which was 15 minutes delayed. And I paid an extra 80 or 90 pounds, I think it was, for a TV that had teletext, which many of your listeners will have no idea what we're talking about. But it was basically an information system where you could go on and look at the weather and look at travel and look at stocks and shares, and you could actually look what was going to be on the TV. So it was fairly limited in terms of its content. And prior to that, my godfather had been a director at Lloyd's Bank, and he had to retire due to ill health. But he used to regularly appear on a program called The Money Program, which was on a Sunday night on BBC Two. And what he used to do was he used to trade within the account. Now, what that meant is that because the system of buying and selling investments was all literally paper driven, so people would literally go around with wheelbarrows of paper and documentation, which led to them actually shutting Wall Street every Wednesday, because they couldn't cope with the amount of paperwork. And that led them to setting up the DTCC, which is basically an electric clearing system. And then they could then trade 5 days a week. So in the UK, you could buy a share on the Monday, and then you'd have the whole of the next 5 days, Monday, Tuesday, Wednesday, Thursday, Friday, and then another 5 days. So the following Friday, you then had to pay for your BP shares. And it was called trading within the account. So effectively, you got 10 business days of free credit. And so he used to basically buy and sell shares within the account. And he had a desk and it was literally piled up with paper because that's how it was all done. And he was doing this in the late 70s. And then he then started traded options when they came out in the 80s. And he kind of left all of the direct equity and really started focusing on trading indices on the basis that 60% of fund managers do not beat the index. So why should you be able to? But if you get the asset allocation right and know when to buy or sell gold, or when to buy and sell America or bonds or the UK, then it's potentially much less risky and you're not exposed to, in those days, we're going back, there was a company called Polly Peck.
Yes.
And Azil Nadir had a very, very successful company. And then one night did a runner, got on his corporate jet and disappeared off to Cyprus.
Didn't he come back recently or something?
He did come back. He did come back. But we also had the era of Maxwell and all other sort of, and because of these people that have conducted nefarious activities, we've seen rule after rule after rule after rule, and the compliance now within financial services and regulation is so onerous. It's typically taking up is 20% of the cost base of banks and asset managers, insurance companies. So I got into the whole subject by really looking at asset allocation, and that's really that's the thing that's really fascinated me. So we were doing that, and then we had an opportunity to actually acquire Brewin Dolphins Unit Trust Company, which is a very well known and established stockbroker in the City of London, and they had funds in the UK and also a suite of funds called CCAVs in Luxembourg, and then we had a range of funds in Ireland which were based on derivatives. So you would actually get paid 12% a year, providing the FTSE 100 didn't fall within a year, and you get your money back.
Can I ask you about this asset allocation? Like, is there anything special that you did on asset? Like, explain what is asset allocation. What is? You said you studied that. What was so special about what you were doing?
Well, if you put your money into the FTSE 100, okay, you are basically then exposed to 100 of the biggest quoted companies in the UK. If you put money into the S&P 500, you're investing 500 of the companies. So you're immediately getting diversification. Now, in the S&P 500 is interesting because at one level you're getting concentration of risk, because the S&P 500 today is dominated by just 4 companies.
Mm-hmm. The big technology companies. The
technology, Apple, Google, Microsoft, and Amazon. And they account for 20%. So at one level, you've got huge exposure to tech. But at another level, if you take someone like, particularly, you take someone like Google or Microsoft, to be fair, they are global players. So they're actually driving maybe as much as 20% of their revenue from the emerging markets. So arguably holding large global companies is an alternative way to get exposure to fast-growing emerging markets.
That's so interesting, because on the one hand, I think what I'm hearing is if you put it into, let's say, an ETF, we'll probably come on to that later, but let's say the S&P 500. But then you're not really that diversified because you're just in stocks and shares. But then on the other hand, and you said that there's a concentration of these technology companies, but then 20%. On the other hand, but on the other hand, they're very global. So therefore, they're quite stable. So it's quite interesting because, it is, it isn't, it is, it isn't, it is, it isn't. It's really interesting if you really look at it.
So that gives you your equity compound. And then you start looking at, okay, so most people they're not in the super wealthy league. When you manage money for very, very wealthy people, which we've been very privileged to do, their primary concern is preservation of capital. They've got rich by looking after money. They haven't got rich by basically betting the farm on a particular idea. And so
what are they happy with then, Jonny? Are they happy with 3-4% a year, or what are they happy with?
If you can achieve a return of 2 or 3% over inflation over the long term. So picking back in the 80s and 90s, people always strove, if you can give me 10% per annum on my money, I'm really, really pleased. Now, to get 10% on your money today, you've got to take a little bit more risk, but you've got to understand what the risk is that you're taking. And if you end up buying a whole load of funds or a whole load of shares, you may find that actually you've got the very similar exposure, even though you think you're diversified. So, for example, in an extreme situation, there's no real point of you owning BP and Shell. You've got exposure to one sector. You've got exposure broadly to that part of the economy. Even though you could argue, well, Shell's a Dutch company and BP's a British company. No, they're not. They're both global companies. Mm-hmm. And so what you need to do is have exposure to the different asset classes. And the asset classes crudely or broadly are equities, bonds, commodities, foreign exchange, and then alternative investments. Mm-hmm. And very interesting, even the professional fund managers within the funds, they were, and we were talking about this, if you remember a little while ago, I was telling you about efficient portfolio management. And professional fund managers have always been able to, or for a long, long time, been able to use effective portfolio management or efficient portfolio management. So they could use futures and options, which are a type of insurance. So rather than selling your BP shares, they could buy, they could sell a future, or they could buy put, a type of option. So if the share goes down, the insurance goes up. Because actually taking that insurance sometimes is cheaper than selling the share.
And do they do that?
No, they don't. No, they don't.
Right. I was always wondering about that because it's a cost, isn't it?
It's a expertise.
Oh, so they do it because they don't have the expertise.
And it's more hassle from an administration point of view, because you've got to start opening up a different type of account. You've got to start trading margin. It's a lot of it is knowledge. And the other terrible thing is that still today, and you just don't take my word, look in the financial press, very few people talk about your risk adjusted returns. Mm-hmm. So I've made 20% in a year. Well, that sounds good. I've made 5% in a year. Well, that sounds bad. Well, if you've made your 20% by it doing that, like a zigzag up and down all over the place, whereas you made your 5% by just a very, very small, but it's actually 5% actually in today's terms compared to what you get in the bank is brilliant. Yeah. If you've had very, very low volatility. So what you need to look at is, what have you made, i.e. the return, and how has it been made? How many sleepless nights has it given you? Right. And there was an economist back in the 60s called William Sharpe, and he came up with a Sharpe ratio. And basically you take your return. So gold has gone up 30%. Okay. You then take away risk-free, which is normally seen as, say, the government bonds or US Treasury bond return. So, let's call that 2-3%. So now you've made a net return of 27, 30 on gold, 3 on bonds, so 27. Okay. And then look at, and this is where it gets all a bit yucky, you look at the standard deviation of gold. Now, if you go back in time, some of your listeners remember and viewers remember those funny bell-shaped returns when you were in your maths class, and it was talking about the bell curve. Yeah. So if we take as an example of, get 100 of your listeners in the room, and they are all going to be somewhere between 4'5" and 7 foot. So you've got tiny people over this side and huge tall people over there, but they're all going to be in a very narrow range. Yeah. But if you look at their wealth, you're going to get some people perhaps over here who are perhaps they've still got debt because they've been at university. And you've got other people who have been left a lot of money and maybe got property worth several millions of pounds. So the distribution of returns is very, very wide to wealth, but very, very narrow when it comes to their height. Mm-hmm. So in investment returns, the distribution, the ups and downs on gilts and bonds, government IOUs, is very, very narrow. But the distribution on cryptocurrencies is huge. Now, it's okay to have that big return on cryptocurrencies, provided that you've had big rewards. Mm-hmm. So if you've got a cryptocurrency that's actually been hugely volatile and gone from, 0 to 100 and back to 0, well, that's not so great. But if you had huge volatility and great returns like we have on Bitcoin, which has gone from 0 to 20,000, currently around 10,000, during that time period, you've had some really great returns and you've been rewarded for the risk.
So what do you suggest? Do you put less money in you get exposure to all of them? So then you have asset allocation, diversification.
Absolutely.
But smaller amounts on the ones that have more risk, maybe.
Yeah. So what you want to do is actually have a balance of all these different assets, because if one asset goes down, then another asset hopefully will go up or stay sideways. So, for example, you might want to have some money in a solar ETF, which the returns aren't that great, but they're very safe and steady. The sun's been shining, they're paying a nice steady income flow. And if suddenly Wall Street crashes because, you know, I don't know, the Chinese fall out with Trump or something like that, it's not going to affect that. It's not going to affect it at all. So the idea is you have a broad spread of investments, and that's called diversification. And then it's much cheaper to move something like an ETF from one area.
Hold on, but so somebody like you and me, individuals, we can do that very simply. But if you are governed by the FCA, the Financial Conduct Authority, then, you know, you read the brochures and they generally don't. Do they generally have, we're in this, and this? Or do they go, we specialize in this? And you go, oh, they must be the experts, you know?
Yeah, well, okay. So if, and I've employed fund managers, so I've got the experience of that. So I say, Marcus, look, you're really good at picking US stocks. Okay. So I'm going to measure your performance as an individual, and you're going to get paid a bonus, and it's going to be comparable to the Russell 2000. So that's an index which measures the performance of American small companies. And if you have actually beaten the Russell 2000 over the next year, then as far as I'm concerned, you're really good and you're going to get a bonus. So you could have lost 20% and the Russell 2000 is down 30%, and you're going to get a bonus. You're going to get a bonus for losing money.
I don't understand that. I mean, I understand it, but I don't.
I know, but your job, I don't want you to take risk outside of that, because I've got one of your colleagues is investing in your fund, and he wants exposure to that asset class. He doesn't want you suddenly to go and buy gold, even if gold goes up. He says, well, no, I've got gold elsewhere. I want you to do your job. Just invest in smaller companies. I don't want you to go outside. Sorry, I'm doing a lot of waving around here.
No, but I get that. But this is what's so interesting. And I actually talk about this on one of my one-day events, where I say, look, as long as a fund manager can say, look, you know, and I use the example that the whole market's dropped by 20%, but look, I've only lost you 19%. That's good, isn't it? And you're like, hold on, you've just lost me 19%.
Yeah.
So I don't know, it just seems crazy. Like, yes, beating the market, great, but I'd rather just always make maybe 5, 6, 7, 8, 9% a year.
But Marcus, it's like many aspects in life, and so I'm sounding a bit like an old codger here, but if you understand the rules of the game, it makes things so much easier. So if you understand the fund manager isn't there to give you absolute return, he's only there to give you performance relative to his benchmark.
Well, I think a lot of people don't realize that.
They don't realize it. And they don't look at this risk-adjusted returns. They don't hold you'll find very, very few fund managers in their regular quarterly briefings actually tell you, oh, we have actually on a risk-adjusted basis. They don't tend, now the institutions do. In the same way, you'll find very, very few retail funds that will give you exposure to foreign currencies, because the perception is, oh, no, foreign exchange, that's really volatile. No, it's not. It's one of the least volatile asset classes. Why? Why? Because it's the biggest. It's the biggest asset class.
It is the biggest asset class. What are we talking about? 5 trillion a day?
5 trillion a day. 4 trillion a day just in London. And London's 40% of the market. So it's about 10 trillion a day.
Okay. Overall.
So, New York's 20%.
But hold on, when you say it's not volatile, it is quite volatile. I mean, compared to what? I mean, it is quite volatile.
Compared to stocks. Compared to stocks and shares?
Compared to stocks, I would say it's volatile, right?
No, it's really involatile. You know, to see the cable, because of the cable that went across the Atlantic to UK, pounds against sterling, you saw that fall or rise by, 2% in a day. That would be headline news. Just doesn't do it.
Got it.
Over time, look, over the last 30 years, what's the pound dollar? It's been between 1 and 1.5.
Mm-hmm.
50% increase, 30% decrease. That's nothing. Not compared to equities, not compared to cryptocurrencies, not compared to 20-30% fall in property prices.
For sure, not cryptocurrencies, and especially some of the smaller ones, for sure. Like, just quickly, what is it? I mean, I need to know, and I'm sure people want to know, what's it like waking up to having $1 billion under management? What's that like, of other people and other people's money?
Yeah, I used to find it quite humbling, because someone has given you their hard-earned money, and they're trusting you that you will do what you said you would do. And so, yeah, a huge responsibility. And one of the main reasons we had the business outside of London in a place called Guildford was because within the city there's a huge amount of arrogance. It's almost if it's my money. I'm the fund manager. I know best. You don't know what you're talking about. That's why you're giving it to me. You think, whoa, hang on. It's at the end of the day, I only earn money because someone gave it to us to look after. And so, yeah, it is. It is worrying. And sometimes when you see, on a Friday night at 9 o'clock and Wall Street shuts, then there's some sort of action or activity on a Saturday/Sunday, and there's nothing you can do in terms of trading until Monday morning. And this is one of the weaknesses of the current financial system, is because the market is essentially closed. So let's say your portfolio is up here, and then you've got 48 hours of news, and that's where you get this cliff. It literally falls off. So therefore you got that cliff, that drop of maybe 10, 20, 30%, because you can't trade your way through, because markets don't trade 24/7. And look at, it's crazy. Take something like copper. Copper is a stable commodity of our economies. We need it in so many different ways, and yet you can typically trade copper 5 hours a day, 5 days a week. Madness. And right. Therefore it is more volatile, because they've got to squeeze 24 hours worth of trading into just 5 hours. So
and that's why I guess people like FX, foreign exchange, because it is open all night, at least 5 days a week anyway. And now cryptocurrency is 24/7, which is amazing. Yeah. Quick question for you about, you're clearly a wealthy man and you've managed a lot of wealth. But what does success mean to you? And do you consider yourself to be successful?
I don't think you can measure success in terms of money, because money is such an ethereal thing, and it's a bit like driving a car. I don't care what car you drive. There's always going to be someone that's going to be flashing you on the fast lane that wants to go 101 miles an hour as opposed to 100, or 156 miles an hour as opposed to 150, whatever it may well be. And so therefore, I think success is if you measure it in terms of money, then it just becomes relative to the next person. And some of the happiest people in the world are completely destitute. And some of the people that seem to smile the most, and I've been fortunate and traveled, and you see in other countries, and they seem to be far happier than we are with all our so-called material goodies. And I know the Americans used to have that expression, "He who dies with most toy wins," and your corpse is put into your Ferrari or your sort of Bentley as it slopes into the grave, and so, oh, wasn't he successful? Really? So I don't think you measure success by money. Certainly I don't. But
how would you measure it
then? Health and friendship. That's how I'd measure it.
Health and friendship.
Yeah. Okay. Because ultimately, if you've got good friends and good health, then I think you've led a successful life, and you've been. If you tell the truth long enough, you get caught.
If you tell the truth long enough, you get caught. In other words, people find out you're a great guy.
Oh,
I've never heard that expression. That's really good.
But the thing is that if you tell the truth, it's easy to remember what you've told you.
Yeah.
If I keep telling fibs, then no one's clever enough to remember all the different fibs I've told. So they end up getting caught because you said, well, hang on, but you didn't say that last time, Johnny. You said this. And I said, oh, really? Well, I must have said it to someone else. Yeah. So being successful, being honest with yourself and being honest with the people you deal with. And that's why at the very beginning I said, I'm not an expert. Yes, I know about this little tiny part of the economy. I know a reasonable amount because I study. I find it interesting, and I'm disappointed that most people have never been given the opportunity to understand it, because most people don't spend the time. One of the simplest things in the world is just regular savings, and the power of compound interest rates, and this should be absolutely drilled into us at school, but it's not. And these are really simple little tools, and it doesn't need to be complicated. And if you put these little baby steps in place, it's obvious you don't put 100% your money into one share, one fund manager. That's just obvious.
Is it obvious? Well, it's when you were saying just now, because when you've only got, let's say, 1,000 to 5,000, and you look at this brochure, it's likely that people are going to put it in. But what we were talking about before, if one fund manager specializes in that, then find another one which specializes in that. I don't know whether that's so obvious, but it's obvious. But it's
But it's
not
obvious
obvious.
it's like many things. When someone tells you something, then it becomes obvious.
Yes,
So we need
exactly.
to
The
tell
secret is
people.
only a secret one. Yeah, exactly.
Yeah, so it's part of that education process. And to be fair, that's why we run these monthly meetups when we're allowed to,
Yeah.
called they're called meetups. They're like masterclasses, a bit like you do, but we don't talk about individual stocks and shares. We're talking more about the technology and digital assets,
Right.
and we get from
And let's get into that. Let's get into cryptos, okay? Because fewer people, I think, truly understand how Bitcoin or other cryptos work, and even fewer still understand the game-changing benefits and risks of cryptocurrencies and blockchain tech. So what is your view on that?
Well, I think go back to the copper problem. Only being traded 5 hours, 5 days. I think that what we've seen with cryptocurrencies, I think they will prove to have done society, not investors, society, a massive, massive favor, because they have forced themselves onto the headlines, onto the agenda. And whether you invest them or not, many, many people are now familiar, certainly with Bitcoin. They don't know what it does. They don't know anything about mining, let alone halving or forking or hot and cold wallets. They don't need to worry about that. But what it's done is force people to think, what could you do? And therefore the ability to effectively digitize, take out the paperwork, and create an electric version of different asset classes. So let me give a really, really simple example. Most of your clients will be familiar with the Shard, big pointy building on the South Bank. Now, typically, the only way you get exposure to the income on that Shard is you'd have to buy the building. So you'd have to buy 8% of the building. But there's absolutely no reason why the owners of the Shard couldn't slice up the building depending on the tenants. So on the bottom floor, we have shops. The next few floors, we then have offices. And then we have a very swanky Shangri-La hotel. And then we have the top end apartments. Now, each one of those types of tenants represent different risks. Now, the average investor doesn't necessarily have the ability to understand all that, but certainly pension funds and institutions do and say, look, we don't want any more exposure because we've already got exposure to shops. We don't want any more exposure to offices because we've already got that. But what we don't have is any real high-end, really exclusive hotel rental income and apartment income. So I just want to invest in those two bits, not these two bits. And therefore, what you can do, the owners of Shard in this case, could actually go out and create an instrument which gives you exposure to what you want exposure to. So at the moment, that's just not possible. Or you could say, no, what I want to do, I want to have exposure to diamonds, copper.
But hold on, can you do that right now?
Yes, you could create so there's a company, and this is really, there's a company called Fatburger, and it's a US company, and they were looking to raise $40 million, and they wanted to invest into franchises in the USA. And this was, unfortunately, this was in February. Obviously, a lot of the franchises, the takeaways are still going, and what they did was actually create a debt instrument. It wasn't equity. They said, we want to raise some debt, so we'll pay you an interest rate on the debt that we raise, and the money itself is going to go into these franchises. But what was great about that was, for the first time ever, a credit rating agency called Morningstar, this is a specialist company that looks at different funds, and they actually rated this digital asset and said, this is what we think about it was more the fact that they're putting time and effort to rate these assets. And that's what we need to see. In order to get the institutions involved in digital assets, we need the institutions to feel comfortable with the infrastructure, the fact there is custodians, that there is ratings, and start using the language that the institutions understand. Because a lot of the institutions are actually well behind your listeners and the people that you train, because you're training them.
So let's talk about custodians, because that's a word that comes up a lot. Is that because the institutions are they in yet? Are they trying to get in, and are they waiting for custodians? What's a custodian?
Okay, so go back to when I was running Premier Asset Management. Basically, you're not allowed to hold. Premier's not allowed to hold the assets.
So they can buy it.
They can buy them, and then the shares, BP shares, then get lodged, given to someone independent.
So there's always two parties involved. Okay. Yeah. When you're an institution. Yeah.
So that custodian, i.e. looking after, the assets to make sure suddenly, we don't go and do something which we shouldn't do. Mm-hmm. So it's been put there so it's another layer of costs, another layer of protection, but ultimately the client's paying. So if you look at retail funds, the annual management fee is often quoted at say 1 or 1.5%. But if you look at the actual cost of the fund, it can easily be sort of 2.5%, 3.5%, because you've got the administration, you've got the custodian, and so the things go on, which bumps up the costs of the actual fund.
So are you saying that in cryptos then, are there custodians or not?
There are custodians. So you've got custodians such as Goldman Sachs, custodians such as Fidelity Asset Management. They have a custodian service
for digital assets.
Yeah, for digital assets.
So what's stopping the institutions from coming in and raising Bitcoin to 100,000 or more then?
What stopped the institutions from using efficient portfolio management?
So it's because I always thought there's two things stopping it. One was custodial services, which I guess started happening in 2019, and I guess are being built as we speak. And then the other thing was regulation. So I thought maybe regulation might be stopping it.
No, you can have up to 10% of your assets in a UCITS. So the sort of things you put in your pension or your ISAs, you can have up to 10% not recognised on a stock exchange. It could be unquoted companies. You have to be careful.
An institution.
Yeah.
So I think is it Paul Tudor Jones who just put or he just allocated 2% into his fund, his multi-billion-dollar fund. Is that like he's the kind of the I think one of the first to do that. So is that kind of giving the green light to the others? Because as a manager, you probably don't want to get fired. You go, well, Paul Tudor Jones did it, so therefore, you can't get fired then. I don't know.
Well, unfortunately, it's not as easy as that. But again, okay, so Paul Tudor Jones, he runs a hedge fund. So he runs an alternative investment fund. So in theory, he's got sophisticated investors and he can invest in all sorts of weird and wacky stuff. But look at Renaissance Technology. Renaissance Technology run about 76 billion. They claim that they've been averaging 66% a year. And before everyone starts Googling, that's since 1999 as well. Before you start Googling saying I'm going to put £1,000 in there, it's shut. It's only available for people that work at the company. And they have just allocated to cryptocurrencies.
Okay. Well,
there's a lot of institutions which are involved in digital assets, and you can buy certainly Bitcoin in a variety of vehicles, actually in your pension fund. So it's because you can buy them through. I think they're OSX in Sweden. They have a way of a fund.
Yeah. My children, we all own a piece of that one. There's a Bitcoin one and an Ethereum one, I think.
Yeah, there's Ethereum one, and then you got Grayscale, who is another one that runs basically similar. So you can get exposure to this.
But there's not that many.
No, there's not that many, and I think, but you've also got to look at that. One of the reasons for this is that there's actually, for institutions, there's very little liquidity in cryptocurrencies. They're very, very small. It's not even a rounding error. And in the same way, there's not that much exposure to smaller companies. I know one of your fortes is you're really good at following and monitoring investing and knowing when to buy and sell US smaller companies. And probably one of the reasons you've chosen America, not the UK or Europe, because US smaller companies are bigger and there's more liquidity in America than there is in Europe.
Mainly, yeah.
So, but there's not many people that will buy smaller companies in any country because there's not much liquidity. And if you're a big institution, you want to put 50 million into something, well, forget it. In cryptocurrencies, you couldn't do it. You just couldn't do it. You'd move the price. And the same with most smaller companies.
So they can't, true. So they can't all jump in. Then who are they going to sell it to? Yeah. Okay. So some people say, yes, blockchain, it's the future. Would you agree with that? And then secondly, why do we need cryptocurrencies? Blockchain, yes. Cryptocurrencies.
Okay. Blockchain seems to offer a lot of solutions in the agricultural, in the medical, in the retail, and in the financial service sector, just to name a few. And I think one of the things that we've seen with COVID-19 is actually people realizing that they need to understand where the provenance, where have things come from? Now, is it right that 97% of antibiotics come from China? Is that what we want? I didn't realize. Okay, so surely we should do something about that.
That's not good asset allocation.
Well, no, it's not. It's not a good way to run your society. You know, do you want to be over reliant on antibiotics of all things? No. Of course not. And IBM have carried out some really interesting analysis. And I was writing about this in Digital Bytes this week, which you might have seen, saying that they did a survey of 19,000 people in 28 different countries. And they said they found that 70% of people would be prepared to pay up to 39% more if they knew where their goods came from. And that's why now, using one of these mobile phones, you can actually get a QR code, and you can actually go and see, where does the chicken come from? Where do the eggs come from? Where does the milk come from? And you can see the supply chain, and you can actually see the farmer. And did it come from a sustainable source? Now, this isn't just marketing and good for the consumer. It's brilliant for the retailer, because a couple of years ago, one of the biggest retailers in the world, Walmart, had a big problem with some of their products. And they had to throw away the whole product line because they didn't know which batch, didn't know where it had come from. So they had to get rid of all of their lettuces or all of their shrimps, as opposed to being able to say, no, we can identify the provenance of that, because those products have come from this part of the country or this part of the world. These products have actually come from somewhere else, and that's where we think the problem is animated from.
Right.
So it saves money.
But for the consumer then so people listening to this, they can just, with a QR code, they can just, like, I don't know what, donk or whatever, and then basically they will know, like, how long it's been shipped for. Because, like you said, marketing is one thing, right? You make it look amazing, but these are the facts.
These are the
facts. And you can make a decision.
So what blockchain, and having written about this now for years, I believe that there's one word that the blockchain consistently, the one word that comes up is trust. And in a world of fake news, trust is a premium. So if you can actually give people some trust in your product, they'll pay, according to IBM, up to 39% more. Yeah. So that means that people will, I believe, we're going to see more onshoring. We're going to see manufacturing coming back to Europe, coming back to the States. And because people will be prepared to pay a little bit more because they know the source it's come from. They know.
Very interesting. That's very interesting.
So the era of hyper-globalization, I think, it's going to slowly decline, because I think there'll be an increased focus on the environment. And I want to know what I'm consuming and its impact on society. I don't want a sweatshop. I don't want child labor. So look at Ford. Ford are using blockchain to be able. So
it's not just about cheap, which tends to be the trend.
Was the trend, because actually having stuff overseas, the real cost isn't cheap, because the cost of manufacturing has risen substantially, particularly in places like China, which is why you've seen now manufacturing going to Vietnam and Bangladesh.
Well, hold on. When you say it's no longer cheap, for us, the consumer, before, and we talked about COVID before the interview, kind of saying how it's slowing things down, people are reflecting, etc. So it'd be interesting to talk about that. But wasn't it just cheap? And yes, I don't want to know about the sweatshops. Like, as long as I don't know about it, then I don't really care.
But more and more companies are actually saying, I want to find out about it. So you're seeing some of the big asset managers are saying, Nike, can you prove that you actually don't do this and don't do that? If you can't, I'm not going to buy your shares.
Wow. And do you think they're doing that because they care about it, or because they think that the people who are investing care about it? Do you think it's led by the consumer?
They claim that if you're a responsible company, longer term, you can give much better returns, because you don't suddenly have, a pile of horrible chemicals you've got to pay to clear up at some stage, or you don't have a lawsuit at some stage against you. So they're claiming well-run, responsible, ethical companies. I don't know, but that's what they.
So I knew it would come back to finances in the end, but I was hoping for a moment. No, anyway. Okay, so really interesting discussion here. Do you think that cryptos are the future? I mean, your financial background, I find it really interesting. Your financial background really is in the city. So you could be kind of entrenched in a way in their views. And now there's this new kind of asset class. But do you think, I don't want to put words in your mouth, so you are obviously a proponent of this, because you write the Digital Bytes on a weekly basis, and it's amazing, by the way, really, really, very, very, very good research.
Thank you.
So why are you concentrating so much of your time on it?
Well, because the current system isn't sustainable, because actually people's portfolios aren't diversified, because they're investing in the same sort of stuff, because it's very difficult to invest in assets which are uncorrelated. And so, tomorrow's a big day if you like your sport. tomorrow we're going to have football. So fifth of June, Premier League football is going to be back on the TV. And you might say, look, there's a really fantastic girl who at the moment she's only being paid £50,000 a year. I reckon she could be the equivalent of the next Beckham. And she's just issued, she's valued herself at a crazy price of £500,000.
Mm-hmm.
And we could invest £500,000 with her, and we're going to get 20% of all her endorsements and all her revenue for the next 5 years. So I can actually have an equity investment in this sports lady who I think is really, really good.
Okay, yeah. And just pause for a moment there, and but hold that thought. So, but could I, or somebody in Africa who maybe doesn't have a bank but has two of these, could they invest maybe $50 in her?
Precisely.
Brilliant.
Precisely. So now let's talk about, okay, that's what if. So let's talk about reality. Let's talk a chap called Dunwoody, who's an NBA basketball player, who this time last year was probably worth around about $500,000. And, you know, God, blimey, nearly 8 foot tall, fantastic athlete, being spotted. And all of a sudden, bang, NBA say, there you go, there's a contract, $30 million. So he's going to get paid $30 million over the NBA over the next 3 years. So he said, okay, what I want to do, I'm going to crunch my 3 years into and say, there you go, I want to raise 10 million and I will pay you 4.95%. So it's like putting money a little bit, lending it's like a debt instrument. And in 3 years' time, you'll get your 10 million back. But meanwhile, you've earned 4.95% as opposed to like 1% in the bank. So yeah, but how safe is it? Well, it's backed by 30 odd million income coming in from the NBA.
So you only do it once it's signed, or in the hope that he's going to sign it?
No, he signed it. So he signed it. So he lodged that. So that's the security behind that 10 million investment. Yeah. And then you got to say, yeah, but what happens if he dies? Life insurance. What happens if
not when he dies, when he gets injured. What happens when he gets injured?
You can get insurance.
Okay.
So part of that you have to take out. In the same way, if you invest in a company, I know you don't ask, but you know what happens if BP's office gets burned down? Well, they've got insurance. What happens if the chief executive gets shot? You've got key man insurance. So
that's really interesting. So you're naming a couple of examples of what the future is this now, or what the future holds in terms of digital assets?
We're right on that point of inflection. So these things are coming through. So if you look at another company called Parking Go, Parkingo, and that operates 80 airports around Europe.
Okay.
Successful business, and they're looking to raise about 15 million. By the way, I'm not associated with any of these, so I'm not trying to promote them, but I'm just trying to think of different examples to give you. And what they're doing is saying, well, we will give you a percentage, not of our profit, but of our revenue. So the faster we grow the business, the quicker you'll get your money back, and then your income will drop substantially. But you've got all your money back, so there's no risk. So we've been working on something called an equibond, whereby it's a similar thing, working with a group of brokers and an exchange and lawyers and accountants. And basically, you'll invest into a company, and let's say the company turns over 5 million, and they raise $500,000. And they say, okay, well, any turnover above 5 million, we will pay out to the equibond holders 10% of that revenue. So if the revenue now over the next 5 years has gone from 5 million to 10 million over the 10 years, that means that the equibond holders have been paid back, because 10% of 5 million increase pays off the $500,000 that effectively was given to them. So the investors now have got all their money back, so no risk, and then they get a small residual income forever, or they could sell their investment to someone else. So it's not equities. There's no dilution for the entrepreneur. It's not debt, so it'll break banking covenants. And it's aligning the investor with the actual company, because you run your own company. And if I said to you, Marcus, I'd love to invest in your company, but I want to pay a dividend. You say, no, Johnny, I'm not paying a dividend. Well, why not? Well, because if I pay a dividend, I've got to pay tax. What I'm going to do, I'm going to reinvest all my profits, because I'm going to expand my business, and I'm going to put a little bit of money in my pension fund, and I'm going to employ, other people. I do not want to pay tax. And that's basically, you're not aligning the shareholders, i.e. in this case you, with a potential investor, i.e. me, because I want dividends and you want growth. Whereas an equibond And with what Park and Go have done, they're combining the interests of the two.
And is all this now, you say it's available, so therefore is it regulated?
Both the yes, the equi bond isn't that. This is a new project we're working on at the moment. We hope to launch later this year. But Park and Go is a security token offering, an STO, so it's subject to all the rules and regulations.
So before there were ICOs, initial coin offerings, that's kind of
not regulated.
Not regulated. So now in the new kind of package is the STO, security token offering. So a couple of sentences on that. So do you get shares in the company or shadowing the shares? Or
it depends what it is, but effectively your investment is backed by bonds, or it's backed by an equity in the company, or backed by copper, a commodity, or it's backed by Dunwoody's NBA contract. But what we're now seeing is it's not just individuals and very, very clever guys and girls coming out of, say, Ukraine or middle of America or out of the Middle East. You're seeing the World Bank. The World Bank have issued twice now, in conjunction with the Australian government, 50 million times two, so over 100 million of Bondi bonds, as in Bondi the beach. And they're actually using blockchain as the technology to actually create a bond, a digitized bond. And according to HSBC, they reckon the cost of using the technology and creating a digital version of a bond is 90% cheaper. 90.
So then once this happens a couple of times, everybody's going to be...
Everyone's just going to jump in on it. And I think that's why I use the word a point of inflection. So I'm talking to some of my old muckers and my peers in the asset management world, and they're all saying, look, we don't want to be the first to digitize a fund, but we want to be a really, really close second.
Yeah, this is what I'm saying. It's like when Paul Tudor Jones, like he's one of the first, then people are like, ooh, So it's really interesting. Like this inflection point seems to be happening, although I think we've been talking about it being an inflection point for a while. But it's just, when they say success is just around the corner, but sometimes that corner is bloody long. But why cryptocurrencies though? Like I understand blockchain, digital assets, etc. Why do you need these little coins? Do you need these little coins? That what? I do this. It's not physical. I don't know why I do that.
Okay, so I think cryptocurrencies. Look, there's 5,536 cryptocurrencies according to various different publications that are out there. Unfortunately, 90 to 99% are utter. They will not last. They're going to disappear, and that's fairly normal. If you look at business as a whole, something like 2/3 of businesses have failed within 5 years. That's just normal. And there's no, and then you've got the fact that these things weren't regulated. There were a number of dubious characters got involved in them. So that the success rate will be even less in cryptocurrencies. But I think what we need to start looking at, and this is where we start looking at a shift in the economy and a shift in society. For too long now, your data and my data has been used and abused, and we've not been rewarded for it. And also for the last 20, 25 years, we've all been subject to something called nudge economics. Now, nudge economics is when you get in your car, you'll find a seatbelt and you're nudged to clunk, click, I put your seatbelt on. Most of us in our houses, you don't have one refuge bin, you have 3 or 4. So you're encouraged to recycle your rubbish, your pension funds. You're encouraged, you're nudged to put money into a pension so you get tax relief. And so it goes on. So nudge economics is a very well used economic theory. How do we encourage people to change their behavior? And we're all, again, subject to it. Most of your listeners will be, probably have gone into Nero or to, Costa Coffee or to Starbucks, and they've had a little bit of card which gets stamped.
Too right, mate.
You've got 9 stamps.
Yeah, free one.
Yeah. Well, how about this? If you go into Starbucks and actually say, okay, I'll have a Starbucks card, and you preload it, then you can sometimes jump the queue and you can actually get paid a bit quicker. And Starbucks now have 1.7 billion of people's money sitting on their prepaid cards.
But it's not, prepaid. Oh, yeah. Oh, hello. Yeah. Okay. Yeah.
And last year they said, well, we don't reckon 10% of those cards are lost, stolen, forgotten. We're going to write back $150 million into our P&L because we think you've lost them.
What?
Yep. Now, for
Wow.
Starbucks to go and borrow 1.8 billion, they would have to pay around about 4.75%. So that's worth to Starbucks another $75 million. So just those two things on their prepaid cards increase Starbucks profits by 5%.
Wow.
A lot of coffee got to sell for 5%.
Okay,
more.
but for the consumer, what does it mean?
So for the consumer, so what's going to happen? I think the whole thing's going to be flipped on its head, and they're going to start paying you for your attention. So in the same way, when you actually go into Starbucks, or you go with an airline, or you use your credit cards, you get paid your Avios points, your Tesco club card points, etc. So you can go to Tesco's club card today, and you can spend your £10 worth of points in Tesco's and get £10 off your shopping. Or you can go to Pizza Express and get £20 off a meal, or you can go to Eurotunnel and get £30. So hang on, there's an arbitrage here. Because I never go to France, or you never go to France, and I do. Well, I'll pay you £15 for your £10. So you're saying, brilliant, I've made an extra 5. I'm delighted because I've turned 15 into 30. Now, all this is really clunky in paper. Once it's digitized and it's on an exchange, I can say, I'm just about to book Eurotunnel, and I'll pay anything up to £28 for your £10.
So you're saying there will be, or maybe there already is, a company that offers me with my Costa Coffee card, for maybe my wife, and I don't know, but I don't want to use it, but I do want Starbucks, well, that's too close. Let's say, but I do want to rent a car.
You might want a haircut, or you might want to go to a restaurant.
Yeah.
And so therefore, what you're going to start seeing is people's attention being paid for. So instead of Google and Amazon and Facebook capturing your data, and then look, Google and Facebook, 90% of their income, their profits come from advertising. They're basically advertising what you're doing, your activity. But I think we're going to see more and more companies effectively issuing their own loyalty schemes. And the mentality is becoming a farmer looking after the clients, not a hunter. I'm not constantly looking for new clients.
Okay. So like Brave Browser, which is
yeah, Brave Browser, another good example.
Every time you agree to look at an advertisement, so you agree, you actually get paid. Whereas okay, so other companies.
It's like in our space, there's something called blockchain radio run out of Ottawa, goes to 85 different countries around the world. You can actually get paid to listen to the radio in cyber FM tokens. So you're just sitting there listening to it.
So that's like a cryptocurrency, a token, or
like a token. Yeah, it's like a token.
But it's digital, you don't see it. So I don't know again why we're doing this. But
and then you can use that potentially if they've got an advert going on that radio station and say, okay, well, I'd like to use these tokens. I can either go and sell them in an exchange, or maybe I can exchange them for a discount for one of your masterclasses. Because you're happy to accept them because you're getting access to a whole new audience that you weren't otherwise exposed to.
Yeah, for sure.
But let's look at something very, very simplistic. And many of you will be familiar with a company called SC Johnson, who make glazed boot polish and fresh and air. Big household company. I think about 8th or 9th biggest company in America in the S&P 500. And they wanted to make a statement about social responsibility and cleaning the environment, because they produce lots of plastic bottles where, squeezy bottles for cleaning showers and stuff like that. So they teamed up with Plastic Bank, which is a charity, which is trying to recycle plastic. And so far they've recycled, I think it's over 8,000 tons of plastic, because they've gone to people and said, look, if you pick up plastic and give it back to us in great big sacks, we will give you a token. We're not going to give you money, because if we give you money, the chances are Dad's going to come back, flip around the euro, and he's going to go back down to the local bar and drink it. But most of the kids are walking around with one of these, i.e. a phone, and they put them on a token, a coin, a credit, however you want to call it. And they can then exchange that for food, for books, for clothes. And so they're giving money directly. And these are in places, very, very poor places, in little villages in Indonesia or in Egypt. And they can actually say, well, there you go, there's some economic benefit for the individuals, but we've also change your behavior to pick up the plastic on the beach or in your street. And that's why I see, the cryptocurrency does a huge favor, because these are little tokens, they're credits. They're not there for investment purposes, but they're there to nudge and change your behavior and give you some economic benefit from your activity.
So I've got a question for you about, you've managed other people's money. Do you think that anyone can build wealth for themselves?
Yes.
Oh, that was very emphatic. So what makes you think that?
10% of your net money every month, save it. Put it away.
What do you do with it though?
I'd be putting it into a variety of different assets. So if you haven't got any exposure to cryptocurrencies, obviously we're not allowed to give financial advice, but
Sure.
I'd be looking at some sort of regular savings into, there's lots of investment trusts, into emerging markets. You could obviously put a little bit of money every month away into a bank, a building society, and you actually have 3 or 4 different investments over a period of time into all sorts of different things. And you'll be amazed how quickly it expands and grows.
But what if they don't know what they're doing? Like some people are listening to this or watching this and they're going, I just literally don't know what he said, but I want to do it. So
come along to one of your classes. You look, making money isn't easy. It's about applying yourself and it's about understanding. But why would you want to trust anyone and just, oh, it's too hard, it's too difficult? Well, I'm sorry, if that's your attitude, you're probably going to stay in the financial situation you are. You have to invest in yourself first of all. You have to take it. It's not easy in the sense that you've actually got to apply. You've got to understand. You've got to do a bit of reading. And by actually then having a better appreciation, you'll then be able to spot some of the people that perhaps trying to pull a fast one, because you're saying, well, I don't understand that. And it's not because you're thick or you're stupid. You just don't understand it. Which, if you don't understand it, don't get involved in it.
Yeah, education is so important. That's why. So 10%, okay, of what they earn. So to put it away, and into different things as you're learning about them. One of them you said was cryptocurrencies. Would you say stocks and shares as well? Would you say gold and silver? Would you say?
So an ETF that goes into the MSCI. I basically
ETF, exchange traded fund, like a basket of shares or whatever.
And but it's basically an index which invests in the biggest companies in the world. So who would have thought that Amazon would be the size it is? It was just a bookseller.
Absolutely.
But you're automatically exposed to it. Who would have predicted the success of Shopify, which many listeners never heard of, but it's been a huge success in Canada. You'd have thought, well, surely always Debenhams is going to be around. Well, maybe it's not going to be around. So that's why I say, as soon as you start becoming arrogant and entrenched in your views, it's very quickly to lose money. You've got to always be open to challenging and looking at it. So yeah, you're absolutely right. You mentioned commodities like silver and gold. Well, most investors at the moment are looking at the markets and saying, I'm just not sure. Are we really going to get a depression as bad as the 30s? In which case, where's money going to go to? Well, historically, things like silver and gold have done well. Well, gold's done really well quite recently. Silver hasn't. Okay, maybe I have a little bit of exposure to silver. Okay. No one knows.
So 10%, okay. And then I know you're a great proponent of pound cost averaging or dollar cost averaging, some people call it. So can you just quickly explain that?
Yeah. What I'd suggest you do is there's a really interesting site called dcabtc.com, and
they really should rename that site. Go for it again.
Delta Charlie Alpha Bravo Tango Charlie.com.
Brilliant. Okay.
So if you look at, most people can afford to put away £10 a week. So if you'd put away, your £10 a week over the last 3 years, if you'd have put it into, I don't know, if you'd have put it into,
what about the FTSE 100, an ETF of the FTSE 100, for example?
Well, you'd have saved £1,500. Okay, yeah. So that's £1,500.
That's amazing, right? That's incredible.
Yeah, and if you'd have put it into the American stock market, it's worth £1,500. If you put it into gold, it's now worth about £2,000. And if you put it into Bitcoin, it'd be worth £2,400. So again, people will be there saying, but that's all well and good, but hindsight's a great thing. What's happened over the last year? Well, actually, you'd have now have £530 in your hand. That's how much you would have actually invested. And in the American stock market, that would be worth £495, gold £600, Bitcoin £560. But the main thing is that it's so people don't realize how easy just to put away a little bit of money every month into something, and it doesn't kind of matter what it is, but it's a diversification of what you would normally do.
And it's with relatively small amounts that everybody can do it, and you're starting your journey and you're educating yourself. And it's an average, isn't it? Because sometimes it goes up, sometimes it goes down, but the long-term trend with most of these things, I mean, most people don't realize that, you know, the American stock market goes up by an average of 7% a year over
Yeah.
time. So it's like, well, doesn't that mean we should get involved, you know, or at least get some knowledge?
For me, the biggest mis-selling scandal in personal finances is the poor asset allocation in pension funds to the US economy. The average pension fund only has a 5% asset allocation to America.
And why is that?
You tell me.
Okay,
It's
so it's
absolutely outrageous. When you look at the size of the American economy and look at the size and the breadth and the depth of those companies that are traded in America, and yet, you know, the arrogance of the pension fund managers and only putting 5% into America.
So what are you saying, that most of them, or most of the money's put into the UK? Is that what you're saying? Or?
A lot of money put into UK.
Yeah, that's interesting, because I wouldn't do that. We do US.
I know.
Because two things: liquidity, but the other one is we want that movement.
Yeah.
And we want to be active. When it goes up, I'm not saying we sell everything, but we start coming out, and as it goes down, we feather in. You know, like why wouldn't? It's very simple.
I know, but also the American economy, they as well. Look at Colgate. Use the toothpaste. It's not like 40% of their revenue comes from emerging markets. So you could buy Colgate and you know you're going to get exposure to Latin America and Asia and Russia and Turkmenistan, Uzbekistan and all the other stands, you know. So why would you take the risk? So it's a travesty over the last 30 years that the arrogance of British pension funds have had such a small percentage to such a dynamic economy and such dynamic businesses. But they've, you know, that's the way it is. But again, you only know these things by looking at it and reading it and seeing what's happening. And once you're exposed and invested, you just naturally just pick up on it, and you start taking, maybe you flick through the financial section of the Sunday papers, or maybe you just go online, and when you see BBC come up with a headline, you look at that. Oh, look, that's what that's doing. Oh, I've got a little bit of that. So you take more interest in it.
Yeah. And they say that if you focus on one, because we always say 20 minutes a day, if you focus on one subject, like you read about one subject, not broad, but like that, within a year and a half, you're an expert. Your favorite word. Question, final one. Do you think that we can use cryptocurrencies, digital assets, etc., to really survive and even thrive in this crisis? And if so, how?
I think that it makes sense to have the diversification and exposure to cryptocurrencies. Many of your listeners, again, will be familiar. They've heard you talk about Bitcoin, and I know you've also talked about this thing called Ethereum, which is a cryptocurrency. And many of the ICOs were actually launched on the Ethereum blockchain. What I hadn't realized, that there are now 70 million Ethereum holders. There's 70 million people in the world that actually have Ethereum accounts. So we're beginning to see greater and greater exposure and adoption, because as some of these ICO projects are now coming to fruition and beginning to actually help in the supply chains, or in the insurance sector, or the retail sector, or the agricultural sector, or the renewable energy sector, they're having to use the infrastructure of Ethereum. And every time they do a little transaction, there's a tiny little charge, and that's slowly increasing the usage of Ethereum, which over time should actually increase the price of that cryptocurrency, provided Ethereum can cope with that massive demand. Because think of all the cars in London. If they all came onto the street at once, London would be gridlocked. So if all of those ICOs were a success and started using Ethereum, I believe Ethereum would fall over. But which is why actually a big failure rate is a good thing for Ethereum, because Ethereum actually was never designed to be this monster that it's become. So I think it was something like 80% of all ICOs were put onto that one blockchain. But there's some other great blockchains out. You look at Stratis. Stratis is doing some fantastic work. I am an advisor there, so I am biased, but that's another completely different,
insider knowledge. Hold
on. But yeah, you know, some really interesting stuff that
I do hold Stratis. But let me have a look at that again.
Yeah. So yeah, I think it makes sense to have exposure to this as an asset class.
But and would you know what's so good about that is that you've got to, people watching this got to understand, this is somebody who was in the city and had 1 billion under management. So for that person to be saying that, I think just really does say something. I don't know whether it says something about you or whether it just says something about,
But the other thing, people say you can't spend it. So I know, because we laughed at this. In DigiBytes, we had this article about a man on 22nd of May 2010. Oh, Laszlo, and he spent 10,000 bitcoins on 2 pizzas, which in today's money means each pizza is 45 million.
And I always make the joke. I really hope he ate every single piece of that. You know how you leave the crust,
even the crusts.
You're like, it's £1 million.
So that was only 10 years ago, and that was one transaction. Now there's various sites, and you can look on there, and there's 200,000 transactions a day happening just using Bitcoin.
But is it growing? Is it growing?
The number of transactions, yeah, is steadily ticking up. But the thing is if you actually take your Bitcoin, Ethereum, and then you can put them onto a debit card with Coinbase, or there's a British company called Banks, BAANX, and you effectively can use your Banks card in 42 million of Visa outlets anywhere around the world.
Yeah, because all they do is they do a quick exchange rate, right?
Absolutely. So if you've got some cryptocurrency, effectively you can use it wherever you like,
of course.
And you can. So it's it's good. And I suppose the worry, the question, the thing we just can't. I can't see the thing I don't understand is the level of debt, Marcus. In the world, we now have 255 trillion of debt.
I don't understand it. I think the only way, and I'm not an economist, the only way surely is if I owe you this and they owe this, and they owe me this, then surely we must be able to just say, well, why don't you just let me off that and I'll let you off that? And because otherwise I just don't see where this is all going. Where is it all going?
Well, the worry, what we've seen is this, well, in France, Germany, UK and America, that they've basically printed cash equivalent to 10% of the GDP. And that influx of cash potentially could be very, very inflationary. So if you take Rolls-Royce this week, for example, because of the problems with COVID-19, they've had to lay off thousands of people. And this is for Rolls-Royce engines and aircraft, not the car side of things. And basically, their debt has been downgraded to junk status, which means anyone that owned Rolls-Royce bonds, and if you're an institutional fund manager, you've got to sell those bonds because you're not allowed to own junk bonds. So if you sell the bonds, it means the price goes down, which means the interest rate goes up. And therefore, the cost for debt for Rolls-Royce is now more expensive. So if we start seeing this happening across the board, i.e. people wanting to have a little bit more return on the money because they're worried about the economic viability or status of the company or the country, then we're going to start seeing interest rates creeping up. And with 250 trillion of debt, look, there's only 14 companies in the S&P 500 which are net cash positive. The only one most of your listeners will be familiar with is Facebook. Amazon, Google, Microsoft, Ford, General Motors, all of them are net cash negative, in debt. Facebook's the only one of the big companies that is net cash positive. So they will come to a stage where we will lose confidence in the economic system. And what will happen is we are going to see a replacement of the US dollar as the world reserve currency. Because it only lasts for about 90, 95 years. These things don't last forever. Right. So before the US dollar, we saw pound sterling. Pound sterling became the world reserve currency because we won the Battle of Waterloo and defeated the French. Prior to that, it was the French franc. Prior to that, it was the Dutch guilder. Prior to that, it was the Portuguese escudo. So for the last 500 odd years, they've all lasted about 90, 95 years. The US dollar has been in place for about 94 years. And it's only a matter of time before people lose confidence. Well, they just lose confidence and say, do you know what? We actually don't want to use US dollars to buy and sell crude oil. We're going to use another we're going to go back to using stones or gold, or we're going to use the renminbi.
The digital yuan. Is it yuan? The digital yuan?
Yeah. Which came out last week.
Yeah.
And basically they want all in place for the Beijing Winter Olympics in 2022. And what that gives the Chinese government, it enables them to crack down on their 1.3 trillion shadow economy.
Oh, really? I'm surprised because they're quite central. I'm surprised.
Yep.
Wow.
Well, they're
This is perfect for them, isn't it? Blockchain and everything.
oh,
You can control your people even more now, can't you?
absolutely. So you've got complete control of their spending and knowledge and what and where. So when they print cash, it's gone. They don't know where it's gone in the market, who's got it, who hasn't got it. Whereas a digital currency leaves a digital footprint. So Marcus, how can you afford to go and buy that Ferrari when your tax returns say you should be buying a Mini? Doesn't make sense.
Oops. Yeah. Yeah.
So it gives them much more control. But also, Marcus, we want to give you some money rather than a bank account. Bang, we can just put straight into your digital wallet. We can give you $1,000 like that. Or inflation is picking up. We're worried now. What we've got to do, we've got to stop you, Marcus, from spending money. So every time you spend money, we're going to increase the transaction cost on spending money. So it's 2% or 3% or 10% to dissuade you from spending money and encourage you for saving money.
Hold on, you talked earlier about nudge. Was it nudge economics or something?
Nudge economics. Yep.
Gosh.
So, but what they're saying, and what's really interesting, if you look at the announcement, that CGNTN is the official website for the Chinese broadcasting company. And in their release that they put out on Saturday, they actually said, well, where does this leave Alipay and WeChat? Which, because the Chinese are already using a lot of electronic payments. They do 40 times more, 15 times more than the Americans do. They've got 40% of all e-commerce payments just in China. And they said, well, what happens to them? And say, well, the thing is with these companies is that they won't know who the transactions have happened between, i.e. the shop and the individual, but we will. So we're collecting this data and we'll know, and that will put us at an advantage. Wow. So does that mean they're looking to try and take out Alipay and WeChat, which are used by about 1 billion people at the moment in China?
Wow.
So at one level, it's very big brotherish and it's very control. But the other hand, look at the economic chaos that we have in this country. Look at the amount of debt. Now it won't be popular amongst some of your listeners, but had we had some form of digital identity in this country with our health records on there, then I honestly believe we wouldn't be faced with 40,000 people dead that we are now. You know, when Vietnam thought they had a problem with COVID, within a week, 200,000 people were confined in government locations to try and crack down.
Oh, and they chose who it was.
You've got a temperature, you're not great, you're not feeling good, bang. Who did you see? Oh, my mum and my dad, and right, all of you.
Where was this?
Vietnam.
Do you know, it's interesting, isn't it? This just goes to show, because in Vietnam, I think, really, you know, but they are just coming up hugely, you know.
But, you know, places like, again, I love America. My sister lives there. I'm very fortunate to have been traveled there quite a lot. But, you know, they are only 350 million of the 6 billion in the world. You know, you got places like Indonesia and Pakistan and Malaysia with 150 million people. You know, 1.4 billion in China, 1.3 billion in India. And we mustn't get too centric around what the Americans think, say, or do,
sure.
which is the US dollar.
But it's the US dollar, but it's also largely a language issue as well, isn't it? Because who do you listen to?
Yeah.
You're a fan of Donald Trump?
But I'm more, having gone through the 87 crash, having gone through, the fall of the Berlin Wall, having seen the Gulf War invasion, there were 2 of those, and then having gone to the 2008 crisis, I think that we are now more interconnected, we're more global, and the speed at which adoption is happening, I'm truly very, very excited. And I think we're going to see many, many businesses effectively digitizing their processes and procedures and making it a lot fairer. So they're going to pay you for your attention. So you will get these tokens. You probably won't understand them, but it doesn't matter because you'll be paid from one place and you'll be able to spend in another place. Many of you will have credit cards with American Express, and you've gone to many sites and say, do you want to redeem your points? You didn't know you had points. And you say, yes, that's £5 off that, or that's £6 off that. And we're going to see, people like Facebook and people like Google have been fantastic at making it very easy for individuals. And once you start seeing them, Facebook have just launched their shop service because they've got 160 million businesses that place adverts on their site, and they're saying Libra is going to increase our profits. Libra is their digital currency they're trying to get going, because my mum wants to give my godson in America $20 for Christmas. So rather than going to the post office and a postal order or a check or foreign exchange, she just gives him $20 worth of Libra, and she can do that as she's sitting there as an 87-year-old because she's obsessed with Facebook, and she gives him $20. He then goes onto a site because he wants to get a new tire for his bicycle or a new steering wheel for his car or whatever, and gives that money to the company that's advertising on Facebook. The company on Facebook gives it back to Facebook because they want to do more advertising. It's a circular economy.
Mm-hmm.
And with 2.6 billion people logged on every single month, it's very, and then now look at Samsung. Samsung have just launched through their app, a payment system so that you can have a debit card with them. Apple have got the Apple Pay. Amazon have got an Amazon coin. So I think you're going to end up seeing corporates issuing their own digital currencies because they're actually stronger than countries. They're in less debt than countries.
So if somebody says, okay, but if everybody launches their own digital currencies and governments doing it, we see China, we see somebody else thinking about Estonia, etc. So if I buy Bitcoin, is it going to be worth anything? Because everybody's creating their own. What would you say to that?
I think there has to be a question over Bitcoin, because the number of times Bitcoin forks, so it's no longer limited to 21 million. Bitcoin is simply backed by people's perception that it's worth something. There's nothing that backs Bitcoin. Whereas if you put your money into Facebook, the Facebook coin could potentially be backed by Facebook.
Mm.
Now, if Facebook use Libra, all Libra is basically they're buying a basket of assets. So a little bit in the dollar, a little bit in sterling, a little bit of euros, a little bit of the yen. So that's just basically a proxy for underlying other currencies. But what I think will probably come through. So you've only got to go back in history. But go back in history in 1831 to 1860. In America, we had 7,000 different types of banknotes. 7,000.
What?
It was 1862. They passed a law whereby they said, now we're going to issue national currencies. And they issued, believe it or not, 1, 2, 5, 10, 50, 20, 50, 100, 500, and $1,000 banknote in 1862. Wow. Incredible. That was worth a lot of money then.
Yeah.
So I think what we'll see is I think what will happen is that there won't be a country that will replace the dollar. I don't think it'll be the Chinese renminbi. I don't think it'll be the Indian rupee. I think what will happen, we will see a version of the World Bank issue a digital payment token, a payment method, which will be backed by shares, bonds, commodities, and currencies, real assets. And it won't be controlled by one government. It won't be controlled by one person who wants to tweet something in the middle of the night, and the rest of the world goes, oh my goodness, because suddenly the currencies are going up or down. And it'll be a much more stable system based on the global economy.
Mm-hmm.
And in the same way, after World War II, we saw the United Nations and the World Bank and the IMF all being established, which are all broadly US-centric because that was the superpower. That had the money. But now we're in a very different situation 70, 80 years on. And I think that it's not going to be easy to adapt to that. But I think more and more people are turning their back on other countries. And we are seeing an increase in nationalism. Look, America, great. Look at what's happened with Brexit. Huge sentiment across Europe, in Holland, Germany, France, which is why the Europeans don't want to make Brexit a success, because they know they've got dissent amongst their ranks within Europe. So I think what we'll see is eventually we'll see this payment methodology, a currency, a token, a coin, whatever you want to call it, and it'll be based on a much broader range of assets, not dependent on one country. But that's just my sort of futurologist for sort of, going, if you look out sort of 10 years time.
And again, so people just coming back to it, and feel free to repeat what you said earlier if that's the case. But our final question is really, so knowing all this, how can my listeners profit from this? How can they make sure that they gain some upside through this whole new trend in digital currencies?
Well, I think the first of all is that they need to, unfortunately, it's not easy. They need to spend a bit of time and they need to educate. and they need to, listen to, people like yourself who are trying to train them and help them. And there's lots of different companies. And, I know you perhaps won't be totally pleased me saying, but you're not the font of all knowledge, neither am I. So to do different reading, look at what else is going on, look what's happening. Question the sort of businesses. The last 8 weeks, we've seen more and more people going online. So the businesses that you're invested in, do they have an online presence? You know what the hell is Primark doing? Nothing online. Well, how many businesses that you're exposed to or invested or do business as your company is doing with, that have an online presence? Surely this day and age, everyone ought to have an online presence.
Do they really not have an online presence? But then they've been closed for the last.
And guess what? We've had to pay as taxpayers the pleasure to actually furlough all their staff. 81 million a month potentially. That's cost us. Yet they made 900 million last year. In the same way, why are we paying the supermarkets 2 billion of rates relief when the last time I go to the supermarket, every time I go, I have to queue to go in, and there's no discounts, there's no buy one get one free, there's no special offers. The supermarkets are making a killing at the moment.
No, but didn't they then? Wasn't there something about? Was it Sainsbury's? I can't remember. But then they paid dividends of, like, they got some money in and then they paid dividends immediately. I'm like, are you insane? Like, that's my money going to the shareholders.
Yeah. No, yeah, but the shareholders own the company. So Tesco's paid out 620 million in dividends. Morrison's have paid 3 times the normal bonus to their staff. They're doing so well. But, and everyone looked at M&S and said, oh, blimey, what a mess. Why have you paid 400 million for Ocado? That's looking like a steal now.
Yeah, absolutely. Yeah, but it's taken a while. But blimey, but yeah, well done.
So look at where you're exposed to. Look at where you're invested in. Are those companies, are they equipped for what could be tomorrow, or are we just going to go back to business as normal and ignore the lessons we've learned? I don't think so. We're moving forward, and therefore make sure you've got real diversification. By
the way, what is the difference between asset allocation and diversification? Is one an umbrella for the other, or?
Yeah, asset allocation is deciding where you allocate your different assets. Mm-hmm. Okay, so across you can have asset allocation within a portfolio. So, for example,
60%, 10%, like that, you mean?
Well, the asset allocation in a fund could mean I can't have more than 10% of the fund invest in any one share. So I'm allocating the assets, but I'm only invested just in shares. So you invest in US smaller companies. Your asset allocation, you never put all of your. I think you only put 1 or 2% of your portfolio into one.
No, we only risk that much when we're trading.
Only risk. So you're asset allocating, okay, just a small amount to each individual shares. That's not diversification. You're allocating assets.
Got you. And diversification, making sure that they are different asset classes.
Yes. Yeah.
So that you're hedged.
Well, again, that's another hedge.
Yeah, that's another one.
It's another
the whole
word.
Video on that, guys. On well, listen. Thank you so much, Jonny. Absolute pleasure. And found, even though you say you're not an expert, I think you gave expert-like content there. And I want to thank you very much for your time.
Yeah, we'll do it. Let's do it again sometime.
Definitely, let's do it again.
All right.
So everybody, this is the Success Series. I hope you enjoyed, and not only just enjoyed, but took lots and lots of notes. Maybe we should have told you that at the beginning. And get your family involved in learning this together, because it is a lot of fun to learn how to grow your assets and, and teaching your children how to do it. Absolutely fantastic. Make sure you subscribe to this channel, because we're going to be sending a lot of this kind of very high class and very content rich information to you and to help you and your family not just survive but to thrive. Very, very important indeed. So I look forward to seeing you on the next video. Make sure you subscribe, and if there's any like button around, make sure you click that as well. I'll be most grateful. Thanks again, Jonny, and see you soon.
Very welcome. Bye-bye.